Dhirendra Kumar, CEO at Value Research, is here to talk a little bit more about what your debt fund strategy should be. Dhirendra, hi, good morning. First the question on, we know it's a famous saying that 2016, all in every poll were wrong. And I think 2017, the way debt fund managers bet on RBI's next move, it's a continuation of getting the Brexit wrong, getting Trump victory wrong. And now they've got the RBI move as well wrong. I mean, how could they get it so wrong? And were they right in the first place on betting as to what RBI's next move is going to be?
No, they have been wrong on a couple of occasions in the recent past because, ever since RBI started targeting inflation, the regime, it was actually a change of regime at the central bank, and people are still in their old frame of mind that they look at numbers, they think that this is, and this basically the fund managers anticipate continuation of a trend, and whenever there is a reversal they get it wrong, they don't get it right mostly. Of course, I'm not referring to surprise that we got two and a half years ago, but on most other occasions we see. But most important thing is that should investor worry about guessing who is guessing RBI's move right? The fixed income investment that an investor make is supposed to be a very simple part of your portfolio. If you don't make 9.5%, and if you end up making 8.75% by not anticipating, not doing any gymnastics, that's good enough. That is what the investor is expecting. You are basically looking at stable return, predictable return, safe return, and you are not looking at interim such blow-ups. And from that standpoint, I think investors need to de-risk themselves from what the stories that they are being told, because mutual fund industry has gone about innovating too much beyond a point which cannot be sustained, which cannot be justified, which cannot be logically explained. So they go about creating a story, and then they go about and it gets a life of its own. That should not be allowed. Investors should keep it very simple. Money for few days, few weeks, keep it in liquid fund. Money for few months, keep it in conservative short-term debt fund which has a track record of not doing anything complicated. And likewise for the debt fund and most other categories, most investors can do without, because they are just supposed to complicate our life. They were launched at some other point. They were actually launched to strike a chord with an investor who was otherwise not listening. So it is basically an unproductive effort in the garb of innovation.
Dhirendra, let's be real. I mean, when you are nearing the end of a rate cut cycle, big gains from debt funds are unlikely. Last couple of years, interest rates have come out, debt fund managers, they've got their positioning right. Now that the best of the rate cut is behind us, on a 3-year basis, on a 24-month basis, what should be the average return expectation? Should we bring it down from double digit to single digit?
Return from fixed income should always be pegged to what inflation expectation is. And my understanding of a combination of a portfolio, a diversified fixed income portfolio, should be able to match inflation or should be able to beat inflation by about 10 to 15%, which could be good enough. So from that standpoint, I feel that 7 to 8% from a diversified income fund, and if the fund manager is not doing anything complicated and doesn't get it wrong, runs it with great simplicity, I think that should be the return expectation. What we have gotten used to is 8-9% return from liquid fund. That I think is definitely behind us. Income funds, we will have to get down to those kind of expectations only from income fund and tentatively from the best performing ones. But I would urge investors to err on the side of caution. They should be conservative with their selection. Don't get carried by the great numbers that you see in the recent past. Be with the fund which has been more consistent, because that is what your primary expectation from a fixed income fund is. It should not be looked upon based on, of course, one should not even look at past performance or great performance from equity fund, because that is past. but more so in case of fixed income fund, which are definitely not sustainable, and that is not your need.
Dhirendra, you've been pretty critical of the fund managers bunch, that they've been selling fixed income products up until now as not a capital protection product, which they are, inherently supposed to be, but as a capital appreciation product. What can fund managers do here in order to sort of not sway away investors who are perhaps watching us and, wanting to know now what's going to happen to their investments post the carnage that is played out on 8th and 9th Feb?
They should just give up on over engineering the debt fund. It's a very simple product. It fulfills a very important need of an investor. Don't complicate it. Just have 3-4 funds, run it with rigor, and investors will be happy. By not complicating investors' life, by not providing too many options. Today there are about 15 to 18 kind of variety of debt fund available. You have the floater, long term. We don't have many of those underlying instruments or based on which some of these funds are mounted. Look at the nomenclature, look at the credit opportunity, the long term, short term, gilt, the variation that is possible. And I find it very hard. I actually analyze mutual funds for a living, and I find it extremely difficult to classify funds in a very logical fashion. And when I have succeeded to, in 6 months' time, it all becomes redundant because the funds have changed their colors. So, what is the point of this whole exercise? I think one should look at these funds from an investor's perspective. What are the kind of needs that these funds are going to fulfill? There could be one or two opportunistic category. Beyond that, these funds should be very dull and boring funds, and investors should buy them for very different purpose, and definitely not for great returns. Great returns can be found in all other part of the market and can be offered by all kind of mutual funds in most other products, not here. So make this segment, the fixed income funds, as dull and boring fund which investors buy for very logical reason.
So, Dhirendra, any investor works with their goal in mind. So you invest money for a few days, you invest money for a few months, and you invest money for a few years for different goals that you may have as an investor. What are the best suited fixed income products for these 3 categories of investors right now?
Liquid funds, you don't need my recommendations. You just need to look for the lowest expense and buy it, and the best performing fund and the not so great and the average fund, the difference will not be much. Also look for convenience. Today there are funds which are offering look at the DSP BlackRock, which offers an app, or Birla Sun Life, which offers an app, and you get your redemption up to 2.5 lakh rupees in half an hour's time. So you can move the money from your bank to this liquid fund and get it back in half an hour's time, which I think is a great innovation. It should be brought for simplicity and convenience and optimizing your return a little bit. Liquid funds, go ahead, choose your own for convenience. Even if you settle for 25 basis point less, it doesn't matter. Conservative short-term funds, money for few months. I have listed some, the JM Floater Long-Term Fund, or the Taurus Ultra Short-Term Bond Fund, or L&T Floater Floating Rate Fund, or Principal Bank CD. I find them conservative. They have been able to recover fast. They have not been venturesome. Likewise, the conservative income fund, which I find have been able to withstand this whole turbulence, and they have showed, and they also have reasonable long-term performance as well. And they were the worst hit. They were the least hit, and they showed actually great resilience through this turmoil. Invesco India Medium Term Fund, Kotak Corporate Bond Fund, the Standard Plan, Franklin India Income Builder Fund, and HDFC Medium Term Opportunity Fund. I find them to be the most resilient, and I think investors should err on the side of caution, go for conservative fixed income funds.
Now let's talk about balanced funds. In a falling equity market, they tend to give you that extra cushion. In a rising equity market, when bond yields are unlikely to fall, maybe this time the equity component will give you that extra kicker. So stick to balanced funds and stick to the good 2-3 names.
Yeah. Yes, absolutely. If somebody is a long-term investor and is very disappointed with, cannot really withstand the volatility of 100% equity, then, balanced fund proves to be the best performing, best choice. Not only that, I think, I visualize that even for mature, seasoned investors who have been used to equity, we haven't seen the most turbulent of times, and balanced funds are likely to be the biggest beneficiary of that, because the active daily rebalancing by the fund manager is providing you a very different kind of vehicle. Let me also caution you that most of the balanced funds have actually been fairly unbalanced. Most of these balanced funds, which we refer to by their name, they are 75% into equity because of the tax glitch that our tax laws allow only funds with over 65% allocation to equity the tax treatment of an equity fund. So that is why the lure of getting that tax break of holding of one year and making your gains completely tax free has driven funds to up to 75%. So I think go for the more conservative ones, the balanced advantage, which are able to create, maintain a 50-50 kind of allocation with their derivative position and also retain the equity flavor or equity tax treatment. The funds which I like are, quite a few. The conservative balance, the balanced fund of the older kind, Franklin Balanced or Reliance Balanced, I like. The balanced advantage, I've been increasingly being impressed by this balanced advantage of ICICI Prudential, which maintains a over 51% allocation to 50% allocation to equity, yet maintains its legal character of a equity fund.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.